Curran. I'm the CEO and founder of Curran Wealth Management. I want to talk to you today about the market, the war, the inflation, supply chain issues. All of that seems to be coming together in a way which is causing lots and lots of stress in the financial markets. Stock market, bond market, both have declined. People who are looking for safety and income are really confused because on the one hand, it doesn't seem so safe anymore in bonds. And on the second hand, it's not providing real returns. So we need to look at real returns. And it may seem elementary and it's probably economics 101, but when you're on fixed income, whether it's because you receive a stated amount of money every month on a pension, or because you have a fixed rate of return on a security, a bond, CD, whatever, and inflation goes up at 7.5%, and you're earning 1 or 2, and in some cases, pension funds don't provide for cost of living increases at all, it's a very, very stressful period. Now, when will this change in terms of income, fixed income? Right now, we know we have 7.5% inflation, and we know the interest rates we're receiving are far less than that. My guess would be eventually, when the Federal Reserve allows it to happen, rates will increase substantially. But because of the war and concerns over the fragileness of the economy, because of the war and the cutoff of oil supplies, it's becoming less likely that the Federal Reserve will aggressively raise interest rates to stem inflation. So the war, like most wars, tends to be a net contributor to inflation. In this case, not causing the inflation, but clearly contributing to it. We all know what's going on at the gas pumps. We all know what we're paying for energy to heat our homes. And that's not likely to go away anytime soon. What we believe in terms of fixed income, and we've been saying this for a long time, is that we prefer to use fixed income for what it is, a safe harbor, not a place to attempt to get any kind of rate of return. The primary reason for being in fixed income is diversification and providing an outlet for a stable investment. Having said that, I would expect that declines in market values will continue for fixed income. The longer maturities have much more risk than, of course, shorter maturities do. Our view is we stay in the shorter maturities. We're not going to try to provide a rate of return based on increasing risk to try to offset a 7.5% inflation. Let's face it, if we get 0, 1, or 2% in a fixed income security with a 7.5% inflation rate, why would we take additional risk when we're already losing 5 points or more in purchasing power? We can't offset it. The inflation is simply too high for that. So in terms of inflation, in terms of interest rates, we expect that rates will go up more slowly than we would have hoped, but they will go up, and inflation will not come down in the near future. As we've said before, we believe inflation is a long cycle phenomenon. History tells us that, going back to the Roman Empire, inflation cycles tend to be long cycles. So I think we have to adapt to this in terms of rates of return and fixed income, rates of return that we have and what it realizes in our purchasing power. We have to adapt. We have to adjust to it. That's not going away. Those of us who are working, we can hope that our wages will increase with inflation. Those of us who aren't working, who are really dependent on retirement income funds, have only really one choice. You can hope that inflation comes down and we can live on what we have, or we can make adjustments. And so I think people who are on fixed incomes need to make adjustments now and not wait for the future. What does that mean? It means we have to earn more to keep up, or we have to cut back on what we spend. And again, those who are working, that challenge isn't as great as it would be for those who are not working. Is that a pretty picture? Do we have a remedy for that? No, we don't. I'd say stay the course. But we have to get growth, and we have to increase our net worth somehow in order to offset inflation. The only way we know to do that are in assets that have grown over time. Stocks have done that, but for many, it's simply too frightening a time to buy stocks. But I think now more than ever, we have to focus on the long term. And the long term suggests that stocks are a pretty good place to be.